So look at where we are right now. We are literally just inches away from 7,000. And this isn't just another number on a chart. This is a level the market has never crossed before. A huge psychological war sitting right in front of us. So the real question isn't, is the economy growing? That's not a debate anymore. The real question is simple. Is 7,000 the launch pad for the next leg higher? Or is this the top before a real correction starts? Today I want to break down both sides of this, the strongest reasons we could push through 7,000 and the biggest risk that could stop us cold. Stick with me until the end. This one matters. The moves towards 7,000 have been fast, aggressive, almost too clean. It's been driven by mega cap tech, AI optimism, and the idea that the Fed is about to start cutting rates. But here's the thing. Round numbers like this change how markets behave. They act like magnets, pulling price higher, but at the same time, they act like ceilings, where a lot of people decide, okay, I'm taking profits here. This is where psychology meets positioning, and that's usually where things start to get tricky. First, the AI trade isn't just hype anymore. Companies like Nvidia, Microsoft, Meta, they're not just selling promises, they're generating real cash. And when the biggest names in the index are printing money, that gives the S&P real structural support. Second, the market is still betting on rate cuts. If financial condition is, money naturally moves out of bonds and back into stocks. That liquidity alone can push indexes higher than most people expect. And despite all the recession calls, the economy has held up. Consumers are still spending, unemployment is still low, companies are leaner and more efficient than they were years ago. From a bullish point of view, that's enough to justify higher prices. Now let's talk about what's happening under the surface. AVGO, Meta, Microsoft, Netflix, even Nvidia have all pulled back hard, some of them nearly 20% from recent highs. Those stocks are supposed to lead the market. Instead, they're weakening while the index stays near all-time highs. That kind of divergence usually isn't random. We're also seeing healthcare and small caps finishing strong rallies. Historically, when both of those move together, it often shows up late in the market cycle. This isn't full panic yet, but risk appetite is getting more selective. Then there's valuation. The S&P 500 is trading at 4 PE levels above 21. That's well above long-term averages. At these levels, the market is priced for things to go perfectly, and perfection doesn't leave much room for error. Hundreds of billions are being poured into AI right now. The problem? The return on that investment hasn't fully shown up yet. If expectation reset, even slightly, tech and the whole index could feel it fast. Inflation is still above the Fed's 2% target. Add tariffs, supply side pressure, or geopolitical risk, and suddenly the Fed's ease path disappears. The market is not priced for that scenario. Unemployment is quietly ticking higher. Leading indicators are still contracting. And after a nearly 90% rally from the 2022 lows, optimism is crowded. When everybody's bullish, there just aren't that many buyers left. So where does that leave us? The S&P 500 is at a real crossroads. Could we push through 7,000? Absolutely. Markets often overshoot. But the risk reward right here is very different than it was a year ago. Markets don't peak when fear is high. They peak when everything looks good. And right now, the margin for error is extremely thin. If you want to see the exact levels I'm watching, what would confer a breakdown, and how I'm positioning around this environment, stay with me. This is where it really gets interesting. So these are the levels that I'm looking at. The first one is around an 8% pullback, roughly the 6,450 area. The second one is a deeper move, about a 20% correction, down toward 5,700. You're probably asking yourself why those levels specifically? There are a few analytical tools I use to identify them, and I'll break those down in future videos. For now, I'm focused on the SPY option chain for the January of 2026 monthly expiration. And what really stands out are the put walls sitting at 670, 660, and 650. If the market starts to shift direction in the first week of 2026, those levels can act like a magnet for the ETF. And once we hit that first wall and break through it, we're likely entering a negative gamma environment, which can accelerate downside moves and pull price toward the next walls, potentially in a very short amount of time. And as always, remember this: the second mouse get the cheese. Let the first mouse get caught in a trap. Until we see real confirmation of a trend change on the short-term time frame, patience is the key. There's no need to rush into an unnecessary trap. Thanks for watching this video. If you got any value out of it, hit the like button and consider subscribing so you don't miss future content. For now, this is Roy, wishing you a Merry Christmas and a green trading week ahead.